We're looking at the top 6 lithium miners on the ASX as the price of the commodity continues to rise, and so does the demand and the political interest in the commodity itself and where it's sourced. We're going to have a look at the aspects of what are the driving forces behind this commodity right now on the markets. Now we have a look at the price of the commodity. We see that the price in the US has outpaced those prices that are happening out of China. So the supply constraints and the demand in China has not been matched as those in the US. And this is just an interesting aspect of the price over the last couple of days and month. But when we zero out and have a look, we want to understand how the commodity and the demand has impacted the things like an electric vehicle and the price of the materials that go in, or the minerals that go into the battery. We're having a look at a Tesla Model 3, so a 60 kilowatt version, and the cost of a year-on-year change, the cost of the battery cell cathode materials. Now, lithium hydroxide is on the top here. We can see the movement has been quite dramatic. It was $465 US. That was $12 US per kilo back in March last year, 21. Fast forward to the 8th of March, 2022, and looking at $2,440 US dollars. That's $63 US dollars a kilo. You can see the price chart on the right-hand side, and that's 1 year movement. That rapid ramp up is coming since the late part of last year, which is similar to what we saw the year before, where we did see the critical minerals ramp up when Biden was announced as president and talked about his critical minerals. Next, we see is nickel. So we're looking at 47.5 kilograms of nickel going into this battery, where it was 38.8 kilograms of lithium hydroxide. For the nickel price in March 2021, it was $785 US dollars. So that's at 16.5 US dollars per kilo. Fast forward to where we are in the 8th of March, prices have changed a little bit since then, but $4,750 US dollars is the cost. That's 100 US dollars a kilo. Finally, we move down to cobalt. Now, cobalt, we're looking at 2.7 kilograms of cobalt going into the batteries, 145 US dollars a year ago, March 2021. That's 55 US dollars per kilo. Now, 210 US dollars on the 8th of March in 2022, and moving up to 80 US dollars per kilo. So the price difference of these three battery cell cathode materials going to a Tesla Model 3 comes from last year, 1,395 US dollars per vehicle. Now it's about $7,400 US per vehicle. These are the price costs that we're seeing, and that's why we're seeing a massive scramble to get access to the commodities. Now, we do also want to have a look at where this production of lithium is going. So the AFR has reported that Australia produces 49% of the world's lithium. That was for the year 2020. If we have a look at the map in Australia, it's very clear to see most of these, almost all of them, are in Western Australia. We've got a little deposit, another deposit up in Northern Territory. Now, when we have a look at the world consumption of lithium, where the mined resource is going, 46% on the far right-hand side goes into rechargeable batteries. 26% goes into ceramics and glass, thinking of cooktops here. 11% goes into greases and polymers, so that's WD-40 and the like. There's 11% goes into other uses, but if you rip out those combined others, the next biggest one after WD-40 and the like is industrial powders at 4% and air treatments at 2%. So the other key metrics to look at here is that 30 million electric vehicle sales in Australia by 2030 is the expected rate there, or the expected number of sales. $1.1 billion of lithium exports contribute to the GDP in fin year 21. So we're looking at last June. We're almost coming up to another year now. And as the prices have skyrocketed, we do see how iron ore has dramatically impacted in many over the last couple of decades the federal budget, and we will see another kick in the coffers, another boost in the coffers, we should say, for the lithium exports. Now we have a look at the Australian lithium exports in fin year 26. That's expected to be 3.9 million tonnes. And of August 21 that is when August began producing lithium hydroxide. So this is change of the markets. This is what's happening in the change of dynamic just here in Australia. There are some other interesting metrics to look at, because we see the demand ramping up in Australia. We see the miners that we'll have a look at in a minute, the best performers. But there's a lithium deficit roadmap that we're looking at here. So when we're talking about what the exports are used for from the AFR article before, the summary, We're seeing that all lithium produced is expected, 84% of all lithium produced is expected to be used for batteries in electric vehicles, ESS, and portable electronics by 2025. Here we are coming to the end of the first quarter of 2022. So we've got a long way to go in producing enough minerals. Now, this is where the lithium demand forecast comes. If we look at the brown towards the middle of the left, we are seeing that the hard rock assets will keep accounting for most of the lithium output in the future. But all production routes, even those which have never operated at a commercial scale, will be necessary to mitigate the increasing supply deficit within that production base. There will be limited integrated hydroxide capacity, meaning that converters will keep playing an essential role in the future. This is because the question is really, will future supply meet lithium demand? Now, as countries and companies continue to eye out net zero targets and generate energy transition plans, the already growing demand for lithium is poised to pick up in momentum, and we're already seeing that in the share prices on the ASX and internationally. Now, the lack of investment in new production is being in this key raw material being lithium, used for electric vehicles and energy storage systems. That's what's speculated to lead to structural deficit throughout the decade. So even if all lithium projects expected to be online by 2030 are perfectly executed, so everything that's forecast to come online in the next 6.5 years comes to market, there's still 220,000 million ton gap in the 2 million tons in demand expected in 2030. So it come down to this table here towards the bottom third. Now, how long it takes to get a mining project to reach capacity. Exploration is half a year to a year generally. Scoping is another half a year to a year. The feasibility study is a similar sort of thing, half a year to a year. So we're looking at could be 18 months or it could be 3 years. Now, construction, pilot plant operation, and then qualification, that's generally 2 to 4 years. So on the long scale, we've got 3, add this 4 years, we're at 7. Startup, another year, we're at 8. And then we've got coming to capacity afterwards. That's 7 to 10 years to really get full stride and really maximize the efficiencies. So worst case, looking at these new projects, exploration today, 7 years is that general number that's being looked at. So now we move over to having a look at the demand of the share prices, or what the real drivers on the ASX in the last month. What we're seeing is the best performers are some names that we've seen many times. If we have a look at this 2-year chart, we can see that rally moving over the last 2 years and do see that impact that they had of the critical mineral announcements with Joe Biden coming in on this whole sector. So you will see a common move from bottom left to top right as the trend just continues. The 6th best performer for this week, but we're looking at the monthly performance, 17.86% is coming from Firefinch FFX. You can see the rally coming off these bases here. So we're looking at Springs here, turning around off 60 cents and then shooting back up. If you want to learn more about Springs, that's a great trading pattern for a lot of the minerals mining companies on the ASX. So you can click on the link below to understand Springs in more detail. But this is number 6, FFX. Moving out of the Springs, holding above the 200-day moving average and going for a rally 60 to 80 cents. The next best one, SYA, familiar name for those who've been trading lithium for a long time. That 2-year chart tells you the story coming in when the critical minerals are announced. Joe Biden, looking at these announcements here, shooting up and starting that real strong burn in lithium miners across the globe. That's December 2020, January 2021, and it's just kept on firing. Good, strong movement. But what we've seen here is consolidation around the 12-cent period, coming down to 11 again. We're looking at Springs here. So understanding that pattern is a real draw card for trading lithium prices at the moment. SYA, 28.77% for the month. 5th place is QX Resources, 29% return over the month. Having a look at QXR over the 2-year chart shows that they're really coming into stride October late last year and then shooting up. Not the spring, but this is where we look at the high and tight flag patterns. Coming from 2 cents, getting up over 4, 4.8, getting up towards 5. In that short rally, short duration, but a sharp, fast rally. That's the high and tight flag that we're looking at in the consolidation. Now, it seems to be broken down, but the high and tight flag works exceptionally well for small mid-cap miners on the ASX. So that's something we've drilled down into detail with lots of examples on the ASX. So you can click on that to understand more of high tight flags. Then we move up to 3rd place, CXO, 31.1% return over the last month. Core lithium, huge movement on Friday, busting over $1, powering through it and trading up over 110 throughout the trading session. We can see the volume's been increasing throughout January, bit of a dip throughout February, but then it is generally increasing after this contraction of volatility and volume throughout December. Bring this out to that 2 year. You can see they've had the volatility contraction before. That's a trading pattern used by Mark Minervini and has been really useful in the lithium space because volatility contraction patterns show that how these run, stabilize, build a continuation base, and then what to look for when they break out. So you can look at that in more detail. And then also lithium miners, because this has happened twice in the last 18 months. We've seen the whole group contract. So like we saw with CXO, that huge rally and then contract. What happened is for 2 months, we just saw lithium miners break out of VCPs one after another for 2 months. There was over a dozen of them that just kept firing out. So if you know what you're looking for, it's a great marker of how to get long before this kind of rally ensues. So that's lithium breakouts, another detailed one to look at. Here we see it's rallied up, broken over $1. When we want to move on up to second place, PLL, Piedmont Lithium, 33.96% over the last month. You can see that volatility contraction pattern happening here. First contraction, second one is about the same. And then there's a VCP within there, 1, 2, 3, 4 contractions, and then a bit of a rally. Fails and breaks down. Then we see it have a spring and then false breaks down here. So very interesting if you know how to trade the springs and the false breaks. Great trading happening there from 60 cents rallying up towards $1 at the moment. But Lake Resources comes in at number 1, LKE 42.9% over the month. What we're seeing here is ticking 2 boxes, high and tight flag, but it does fail, and then we're looking for a VCP in there. Now they do go into trading hold and then shoot the lights out and massive volume after that breakout and rally. So what we do want to look at is consistently trying to find the things like springs, volatility contraction patterns, and high and tight flags to trade these rapidly moving miners on the ASX.